Well, good evening, everyone, and welcome to the Business of Property on the Property Development Australia page. Welcome, Tony Dimitriadis. I am so glad to have you here this evening. We are just setting up and going live on the Facebook page, and there will be few people that will probably pop into the Zoom room. Tony, welcome. And very excited to have you here because it's called the Business of Property, and what we're going to be talking about is around the business of property, and in particular the financial and tax issues and considerations around property development. So welcome again, Tony. How are you doing?
Very well. Good evening, Cheryl. Thank you for having me on. It's a pleasure to be here, and hopefully I can share some valuable insights for the audience.
Certainly. So what I'm going to do, there may be a few people that ask questions on the Facebook Live, so I'll sort of let you know if we've got questions that have popped up. But really, let's talk about, introduce yourself, who you are, Tony from AD Partners. You're an accounting firm, but more than just that, like, you obviously serve a lot of developers and property investors. And why is that such a passion for you?
Yes, well, thanks again, Cheryl. So AD Partners is an accounting and advisory firm, and we've been running that for over 20 years now. And of course, when you start out, you probably tend to be a generalist, but as the years have gone on, always had a passion for property, and maybe it's part of my heritage and culture. We love bricks and mortar. So more and more, I suppose, you naturally tend to gravitate. So, we over the years have worked with many people in the building, construction and property space. And so the more and more you get involved, the more and more you understand, the more you, relate to all of the business owners and investors within that industry. And as a result of that, you can really add value because you understand their pain, you understand some of the issues that they go through on a day-to-day basis. It's really become an incredible passion, so much so that I've written a book. Some might say that's silly. Why would you go and write a book? But
wouldn't happen to be this book, would it?
Oh, well.
I've just got one
Surprise,
handy.
surprise. Thanks for that, Cheryl. Yeah, yes, it is. So I wrote the book, Build It and the Money Will Come. And it's sort of written in two main sections. One is really the 5 key principles of running your business. And whilst it's written for builders and developers specifically, those 5 key business principles are probably universal across most businesses. We're talking about the strategy initially, then the structure of a business, the statutory compliance, the systems, and then the support teams that you have. So the 5 S's, the 5-star system is critical. But then the second part really goes on into understanding some of the key taxation issues from a property development. And these are some things that, particularly to the novice developer, Cheryl, they won't necessarily understand them all. And I could probably quite confidently say, because I work with it every day, being an accountant, tax is something that a lot of people either shy away from, fear, are frustrated with, just simply don't like. And we can understand that because it's a cost, it's money coming out of your pocket. But it's a fact of life, and like any other cost in business, and in particular with property developments, it needs to be factored in. And so one of the key things from a property development point of view is the financial feasibility. That's probably step number 1. Once you've found a site and you have some idea of what your project is going to be, one of the first things you need to be doing is you're doing your financial feasibilities. And that's critical. And obviously tax, as much as people might not like that, plays a big part in that financial feasibility, and therefore the net profit you might make at the end of the development.
Yeah, absolutely. So what I'd like to, and like I said, what I was really drawn to in the book is that, you know, it is structured like it's a business book, because you talk about, you know, right at the beginning, even what your mission and your values are. Like, people don't often think about development in that sense. They're going to go, oh, I just want to make money. Is there an actual vision and a mission? And it's really interesting because it is a conversation that I had with a client earlier today, who is looking to get into development, and it's a long-term view. And I said, okay, well, let's step back. Like, let's talk about why you're doing this, because at the end of the day, like, just like with any business, there will be challenges, and you need your vision and your mission to be the thing
Really
that pushes
interesting
you, because it is a forward conversation that I had with a client earlier today, who is looking to get into development.
Can
And
anyone
it's else hear that feedback in the background? No, maybe it's just me. Zoom's doing funny things for some reason. Hello everyone for joining us. Apparently I think the Zoom link wasn't working. I have added it to the Facebook live, so please click on the link in the comments below. And if you've got any questions, please do feel free to pop it in the chat or in the Facebook live. So I'm going to continue here. We heard the feedback a bit. Hello everyone. Thanks, Sean. Yes, so again, vision and mission, and we talk about strategy. Like, you know, again, with development, why is that strategy part so important to get right from the beginning?
Well, I think it's important for any business, and it's no different when it comes to property and property development. You need to understand what you want to achieve. Now, we understand, as you touched on earlier, people just say, oh, I want to make money. And that's fine. We all understand that, you know, we invest and we go into business to make money. But I think it's a matter of understanding your strategy and how you're going to go about that, and what you're going to do, what you stand for, what you want to develop. You know, do you want to make your mark? What's going to set you apart from, you know, all other developers? You know, because it's not just as easy as saying, well, you know, I might have some equity, or I might have a reasonable income. I'll just go out and, you know, buy some land and make some money. Everyone else is doing it. Sadly, it's not quite that easy. And so, you know, the strategy, you know, really comes back to the planning and the understanding what you're doing and why you're doing it. Because if you don't get that right, well, you probably end up veering off the road half a dozen times before you get to the end, and the end might not look like what you thought it was going to when you started. So, yeah, it's important to understand that from a general business point of view, and in regards to your developments.
And so, from a high level, what do you mean by strategy? What are examples of you know, a strategy, a property development strategy?
Well, the strategy is again what you want to do from a development point of view, and what you want to get out of it. So the strategy could be that you want to build and hold these finished products and build your wealth in terms of, you know, property. Your strategy may be to continue to develop, flip, and increase the size of the volume of the developments. So you might obviously be starting out small, but then wanting to do something larger, of a larger scale. You might want to get into some joint ventures with other investors, developers, other people within your network. So the strategy is important because you need to understand where you're going and what you want to achieve at the end of the day. So, you know, the hold versus sell scenario is a strategy in itself, and understanding that, and then understanding the taxation implications because of that as well, because that plays a big part. The strategy of planning, planning your development, planning your business. Are you going to get into the business of property development? Because a lot of people don't look at it as a business, but I can assure you that the ATO does. And as a result, if they believe you are in the business of, then you'll be taxed accordingly. And so that comes down to the actions you take along the way, and your transactions with the bank, with real estate agents, with council. All of that is documented, and if you haven't got your strategy right and you don't know where you're going, you could fall foul from a tax perspective.
Yeah, absolutely. So in terms of almost like a little bit like of a timeline, so you've got someone who's saying, okay, well, I like to get into property development. I sort of know what my strategy is. Is it going to be, I need to be speaking to my accountant and lawyer first, or is it going to be, let me find a site which I think is going to stack up and take me closer to my strategy?
Okay. Finding a site is important, but sites you will find, I think it's a matter of actually stepping back and understanding what you want to do at the end of the development. Are you developing to build a portfolio of property and, as I said earlier, increase your wealth? So is that a develop and hold type strategy? Or is it develop, sell? Bearing in mind, Cheryl, that of course your intentions from day one can start out with one particular strategy in mind, and because of circumstances outside of your control, i.e. market conditions change, and we only know that right now. There's no better example of it during this COVID period where, I know there's a lot of people out there saying that the property market is crashing. I don't believe it's crashing. It's in a holding pattern because the reality is people have pulled stock off the market, and so there's nowhere near as many transactions. And I think from a demand and supply point of view, it's actually holding up quite well. But the reality is it hasn't continued to rise like it was previous COVID. So if you had just finished a development and you were needing to sell and your strategy was to sell, you're now having to hold. So what does that mean? What does that mean to your strategy? What does that mean to the taxation implications? Do you now have to try and find tenants to occupy the premises while you wait for the market to correct itself and then look to sell down the track? Are you able to do that? What are your holding costs like? So there's many things you've got to consider. And sometimes, as I said, sometimes things happen outside of your control, and you need to understand beforehand what that means and what you might do as a result.
Yeah. So and I've had many of those conversations, in like you mentioned, where someone has gone into with the intention to build to sell, but they've gone, oh no, we've got to build to rent now. In that particular instance, in terms of structure and tax-wise, what are the things that they need to be thinking about immediately when they've decided at that point it's going to be a build to rent and not a build to sell?
Well, one of the key ones, I think, when we're going from a sell to a rent strategy is the GST, because for those that are going down the build to sell strategy, they may be claiming GST credits along the way. And so if that's the case, and then all of a sudden that strategy changes, then potentially there's GST to be refunded, not refunded, paid back to the ATO that you've collected. So that can be a significant cost, because the GST refunds that you've collected on the way from the development costs you've probably put back into the development so you can finish it.
Mm.
And so you don't have this spare money lying around to give back to the ATO because you haven't been able to sell because you're now holding. The bank may not be able to finance you any more based on your situation because, you know, the bank may have been looking for you to actually sell 1, 2, or 3 of those completed units at the end of the development. You've now not been able to do that. So your financing might actually be in risk, let alone having to pay back the ATO, the GST that you might have claimed back. So that's probably one of the key considerations. From a income tax point of view, a capital gains tax point of view, it's not really an issue because you haven't sold anything. So that part of it actually works in your favour. But the reality is you don't have those funds from the sale anyway. So, you know, how do you sort out your finances going forward? How do you pay back GST you might have collected from the ATO? So they're a couple of the real key issues from that shift from sell to rent strategy.
Yeah, absolutely. Sean says it's really encouraging for him to focus on pre-sales. He says, thank you for that information. Very, very helpful.
Well, pre-sales is critical. Sorry to cut in there, Cheryl. Yeah. I mean, because in a lot of cases, particularly with the finance and the banking sector and what's happened post-Royal Commission, they are really tightening up in this area. And some of them, don't look too kindly on construction finance or even development finance, particularly for the novice developer, because unless you have a proven track record and some experience, they might be less likely to be favourable upon any finance application. So, as was said there, with regards to the pre-sales, very important if you are doing a development and your strategy is, from the sale point of view, is to try and get some pre-sales.
Yeah, and the finance market has changed dramatically over the last 12 months. There was a point where you needed obviously pre-sales to cover debt, and then it went to, we don't need pre-sales. Private lenders were really happy with what the market was doing, and then COVID, and then we went back to needing those pre-sales again. But at the end of the day, having some level of pre-sales is going to help mitigate your risk. In any case.
Well, that's exactly right. And I know that some people might look at that from a point of view of, am I giving up a bit of value at completion by getting a pre-sale or two? But you've got to weigh that up against the risk of, something going wrong or not being able to sell down the end of the track. So at completion. Yeah. So I think, again, you need to, everyone's situation and circumstances are different. And there's no one rule fits all. You really need to, sit down and analyse your particular situation, what's going to be best for you, and understanding, your particular circumstances, your finance capacity, your income capacity, whether or not you can hold, whether or not you might need to, in a 4-unit development, sell at least 1 or 2 and hold 2. There's many considerations from the point of view of what if, and part of the whole strategy piece and the strategy mindset is maybe doing some what if analysis up front. What if I can't sell these things for the value that I believe that they should be? What sort of risk is involved then? Am I going to have to let them go at a significantly reduced value, or am I able to hold them? Am I able to refinance at completion of the development? So all of those things are important to consider.
Let's talk about the feasibility. So at what point, and keeping in mind, I said we've got lots of developers here that might start off with a 1 into 2, or and then sort of scale up from there. At what point do people need to be thinking of adding GST into their feasibilities?
Well, day one. The moment you're thinking of a development, you might be looking at a particular site. You might have done some feasibility in terms of the site itself, council, surveyors, planners, etc. At that point, you need to turn your attention to the financial feasibility. So, yes, I can potentially do this based on my communications with all of those other professionals. Now let's put pen to paper. What does that actually mean? There's the land value, there's those initial surveying and planning costs and council costs. Then there's the actual construction, the build cost. And then there's, subsequent to that, council contributions as well, something that a lot of people don't realise. If you're doing a 3-4 townhouse development site, that you've got to hand over some extra money just because the council want it for common ground. And that can be significant. You know, I've had a client recently who had to cough up a 6-figure sum for a 4-unit development.
Oh, really?
Yeah, in Brunswick. So, you know, it's again, that's not insignificant. And unfortunately, the goalpost moved there because at the start of the development, he believed and was being told by them that, you know, he was looking at anywhere between 30 and 40,000, and it became 100,000 by the time the development was done. And really, there's not much you can do about it.
Not really.
No, if you want a subdivision, you need to pay that fee. You know?
Yes. But being and I'm just going to point out, like in Brunswick, that's an existing established area. I mean, often contributions are higher in an area where you're needing a lot more playgrounds and, you know, greenfield areas. So that's interesting that it's got, like, that's almost 25 grand a pop per unit, which I would think that's quite significant.
Oh, it's incredibly significant. But as I say, you know, we try to assist him in terms of, you know, fighting that, using my words carefully. But you know, there was really nothing he could do in the end. You know, it was that was the fee. But we digress. The point is the financial feasibilities need to be done pretty much after you've done all of your planning from the site perspective. You then need to put that on paper and put numbers around that and understand that you know, there might need to be some what if scenarios, but certainly built into that financial feasibility must be tax and GST.
Yeah. Yeah.
Two different things. So there's the GST, obviously, that you'll pay on any new residential premises that you sell, up to 5 years. So again, sometimes people don't realise that. They just think it's, well, if I sell it at completion, that's it. That's not actually the case. So you could actually rent them out for a short period of time and then sell and still be subject to that GST. And from a, you know, tax point of view, you know, is it on revenue account or is it on capital account? And that's, you know, that's a big one. And if you fall on the wrong side of the line based on how you've structured, you know, you could cost yourself some dollars there as well.
Yeah. Can we talk about the margin scheme and when that applies and when that doesn't apply? And what is the margin scheme?
Yeah, so the margin scheme is a method of calculating the GST that you will need to pay on the sale of one of those completed lots. So the GST on the margin is not your profit on the development, it's the sale price of the completed unit less the original purchase price. Now, of course, if you've purchased one lot, cleared the block, and then built 4 on there, then obviously the purchase needs to be split 4 ways if they're 4 equal size lots that you've subdivided, and the margin is the sale price. Let's say, for argument's sake, you sold for $1 million for one of those 4 lots, and your original land purchase was $1 million. So if we split that 4 ways, the land component was $250. So your margin is that $750, the million less the $250, and GST will be payable at 1/11 of that margin. There is, though, the ability to also claim GST on any costs incurred in the development for where there is GST charged. So based on the consideration method for the margin, you've got the GST on the margin plus the GST on your development costs along the way as well. Now, when can you use the margin scheme? Because that's also important. So you need to understand that whether you can or can't use the margin scheme depends on the original acquisition of the land. So if you have purchased that land and it was GST free or purchased from a vendor who was not registered or needed to be registered for GST, then you are able to use the margin scheme moving forward. But if that was a taxable supply, even though from your point of view when you originally bought it, you're just paying a figure, but if it was a taxable supply to the vendor at the time, then obviously you're not entitled to use the margin scheme. So, we need to understand firstly whether you can or you can't, and then obviously if you can, it is likely to be the better outcome, but not necessarily, because it can vary from development to development.
And when is it a taxable supply? What are some examples of it where you may not be able to apply the margin scheme?
Well, where the original acquisition was a taxable supply, so it was from a vendor who was registered and required to be registered for GST for the sale of that. And as I say, it's not for your standard residential block. I'm not going to give you an exact figure, but I would suggest the vast majority, probably 90+%, is going to be in that category where it's not a taxable supply, and you will most likely be able to use the margin scheme. Sure. Because generally you're purchasing this from, a mum and dad, a couple, it's a standard residential block. They're not in the business of property development and like. So in that sort of scenario, which is the more common, particularly at this sort of smaller level, where we're talking residential blocks, the likelihood is that you would be able to use the margin scheme.
So if someone were to stumble upon, say, a warehousing facility that we're going to be developing, in that circumstance, it may have a taxable supply there.
Absolutely.
Yeah.
Absolutely.
Or how about a subdivision where there's a farm, a farm that operates from it as well?
Yes, absolutely, and that's obviously been common. There's been many farming lots have been purchased and subdivided, and yeah, you're right. The GST in that particular scenario needs to be taken into account. How was that land being operated from a business point of view, and what does that mean to the purchaser of those blocks? So, and of course, GST should always be noted on any contract. How is GST being accounted for? Because you can't just say, oh, I'm going to use the margin scheme after the event if you haven't actually noted the margin scheme on your contract of sale. So you need to be noting that. It needs to be documented on the contract of sale in order for you to be able to use that margin scheme.
Yes, yes. And even with the offers that you put down on a purchase to indicate whether that offer includes or does not include GST.
GST. Yeah, absolutely.
Mm-hmm.
Yeah.
Awesome. Sean has a question here, just to see if I understand this. If an owner I buy a property from has their property under a trust, and feel free to hop into the chat if you want to be able to read that too, Tony. If an owner I buy property from has their property under a trust without GST registration, the margin scheme can apply. But if the same owner is selling me a property owned by a trust that is registered for GST, I wouldn't be able to use the margin scheme.
Most likely, yes, that's correct. But it will depend on how that's noted on the contract as well, whether or not the contract includes or doesn't include GST, or whether the margin scheme is being used at that point by the vendor. So, yeah, generally, Sean's comments were correct, but we'd have to look at it a bit deeper and actually understand the vendor and how he treats that on his contract of sale.
Yeah, excellent. Awesome. Thank you, Sean. Very good question there. I wanted to talk about even sort of like the tax structures that people should be, setting up their businesses, and I will call their businesses and developments in. What are the common ones that are going to be the most, considered in terms of tax effectiveness and ease to set up, I guess, as well. Well, ease to set up is one thing, but it's more, what is the most tax effective sort of structure people should be considering?
Yeah, good question, Cheryl. The reality is that is going to depend. And I know a lot of people don't like that initial response, but one of the key considerations is going to be this whole strategy of sell or hold to rent. So if your strategy is going to be to sell, then the first thing that would be considered from the ATO's point of view is that you are entering into a profit-making undertaking or scheme. And on that basis, the ATO's first stance will be, well, you're tantamount to being in business of property development. You're going into this development to complete a development, sell it, make a profit, and whether it's a one-off or whether it's going to be a continuation. So they would look to put that on revenue account. Now, if that is the case, and if you were starting your journey down the property development business, then a sensible approach may be to simply use the company structure with shares held within trusts, where there can be a distribution of dividends through trusts to obtain the best possible tax outcome of the distribution of that profit and that income. And in the company structure for the actual development itself, if it's going to be considered on revenue account, then now with the tax rates, company tax rates down to 26% for the 2021 year, and then 25% thereafter, it's relatively concessionally taxed from that perspective, because the alternative is, if it's considered on revenue and it's in that individual or trust name, out of the trust is going to go to beneficiaries, which are typically going to be individual beneficiaries, and you're going to be paying tax at your marginal rate, which is tax on top of whatever other income you might be earning, because you might be full-time employed in a job, and this development is something that you do on the side, and you could find yourself losing half of your profits or near half your profits in tax because someone said, "Oh, I'll put it in the trust," and then you've got this thing that's been judged as a revenue transaction, not a capital transaction, and therefore it's taxed accordingly. The whole income gets distributed to you, and whammo, you've just lost half of it in tax. And I talk about this issue of revenue versus capital because obviously with the capital gains concessions that are available, and obviously one of the key ones is the 50% discount on any asset that you've held for a period of 12 months or more. That's a significant carrot, a 50% discount on essentially your profit. So that's why, from a development point of view, you'd like to use that trust structure to try and access capital gains. But again, it comes back to the strategy of the development and what you're actually doing. Are you doing something to sell, or are you doing something to hold and sell at a later date down the track? Mm-hmm. So if tax is a major consideration, and if your circumstances are such that you might be able to hold completed developments for a period of time, at least 12 months, then that might be a sensible approach, because it might be win-win from a tax point of view, but also from a potential increase in value point of view. I mean, the longer you hold these things, you would hope the greater the value of the finished product at the end. So that's obviously a key consideration. Now, of course, not everyone can hold, because some have to sell in order to pay down some debt and then move forward. So we understand that, and that's obviously a consideration that needs to be taken into account. But you might, in that circumstance, forego one unit as a sale if you're holding the other three, for example. So the type of structure is going to be matched by the strategy. And this is what we were talking about at the very beginning, actually understanding what your strategy is. Bearing in mind, as we said, it can change, but generally, more often than not, your main strategy will follow through to the end. So we set up the structure and do the feasibilities based on that strategy.
Yeah.
So the feasibilities are done, accounting for the tax accordingly, based on the structure, based on beneficiaries, and everyone's situation, as I said, is different. Some people can hold these shares in companies or units in trusts, etc., because they've got beneficiaries, family that they can potentially distribute income to. Mm-hmm. If you're in that sort of situation, then that type of structure can be very beneficial. If at the end of the day, all of the profits are going to come to you because you're on your own, quote unquote, then, holding things in a trust that is just going to be distributed to you and you alone, and you're already, earning, a good level of income from your full-time job, you're going to be losing a lot of that profit in tax.
Yeah. What are the considerations for people who are, say, moving from full-time employment and then looking to then transfer to property development full-time, but the concern is serviceability? How am I going to be able to borrow from the banks again if I don't have a full-time job? How can I prepare myself financially and the structures in place and the income that's coming through? What are the things to consider there?
Well, if at all possible, I would tend to advise that you get that first development and finance underway whilst you still are employed. Because the reality is you're going to find it very difficult to get any finance if you don't have any income. So and particularly from the major banks. There might be some third, fourth tier or private lenders that might be willing to do something, based on your equity in the land, because they'll take security over that. But the major banks certainly won't, and even some second tiers probably won't either. So I think if your strategy is that you would like to transition from your normal day-to-day job to property development business, I would be looking to do that first one whilst I was still employed. And funny you should mention that, because I've got a client who's doing that very thing. He's recently started a development, and now that he's probably more than halfway through it. Actually, he's probably about 3/4 of the way through. He's now talking about finishing up at work. And from all reports, he's building some quality products in a very good area. So I think he'll end up doing quite well for himself. And from that, going to the financiers that second time around, after you've done a development and it has been successful, you've got that track record. So they have a level of comfort. You've got some profits from that first one. You've probably got equity. You may even hold, one or two of the finished lots, to then go to the bank with to get that next development.
And then one of the discussions that we often have with those who are looking at sort of purchasing cash flow positive properties, and then having that income being reflected in their business, for example, how do you set that up so that when you're going to the bank or any lender, to be able to say, hey, this is my business of income that comes in from my cash flow positive properties? That's not the exact sort of conversation and the words I use, but if you know what I mean. Like, is it similar to in terms of when lenders are looking at serviceability, is that similar where they need to have 1 or 2 years of that income that comes through your GST and your BAS returns and all of that, and those returns, to see that that, okay, well, we've got this track record 2 years or whichever, and then we'll look at your serviceability?
Yeah, absolutely. And they will dig as deep as they like to, and banks more and more these days are digging very deep in terms of your history and what you've done and what your level of income is, and so the more the better you can present your application, the more likelihood of success. So if you've got that track record in doing some developments and making some money, obviously that's one tick. If as a result of some of those developments or any investments you've made previously, you actually hold some property that you are renting, that obviously helps too. That adds to your serviceability, and more than likely, obviously, your equity position as well. So you need to present yourself as well as you possibly can from both an equity and serviceability point of view, and bearing in mind that whatever you're looking to finance in terms of that next development, that also needs to get added into the mix as well, because there's going to be income being generated from that. So it all gets put together, and utilizing an experienced broker who works in the property development space and works with a lot of property developers is very, very helpful, because they understand the banks, they understand development, and so they can package something up to present to the right bank that will more than likely give you the green light. So, because I suppose in a lot of cases we think of them all as being the same, but the reality is they're not, and they will treat different types of developments and different types of applicants differently. And, you know, we don't know that, you know, if we don't deal with banks day in, day out, but these experienced brokers who deal in property development do understand that, and they understand where you might sit with any particular bank, irrespective of whether you've got a history with them or not, because sometimes that doesn't necessarily, you know, add any particular credits to your application.
Mm-hmm. Mm-hmm. Absolutely. Thank you. Thank you for answering that. I am going to put any requests for comments or questions out to the audience because I've exhausted some of my questions here. But in the meantime, while we're waiting for any to come back, Tony, I'm going to do a little bit of a shout out for your book, Build It and the Money Will Come. Master the 5 Secrets to Successful Building and Property Development Business. How do people get their hands on one of these?
Oh, they can ask nicely, Cheryl.
Ask nicely. Okay. Not just demand. Yep. Or you can practice the negotiation skills. Would you like to do a JV? Excellent.
Yeah.
And,
Well, I mean, they can certainly get in touch, and you know, yeah, I'm not sure whether you want to pass on my details or whether you want me to.
yeah.
But
Yeah, I can pop that in what's the best way? And I can pop it in the chat and also to the actual Facebook feed as well. Is email?
Email's probably the easiest option for most. They can
Yep.
drop in an email to Tony D, TONYD,
Yep.
at adpartners.com.au.
.com.au. Oh, oops. Tony D at adpartners.com.au. And also, I believe there's a financial health check that they can do as well.
Yes, they can do a financial health check, and that can be found at www.adpartners.com.au.
Yeah, financial health check.
/financial health check.
Perfect. Oh, we've got another question here. Awesome title for the book. Oh no, it's statement. If I was to set up a trust for our kids each, how much would they get taxed on it? Say, for example, 100,000 in each of them, or for each of them, or set up a trust for our kids each. Oh, okay, 100,000 trust for each. How much would they get taxed for a kid's account under 18? I'm assuming.
Okay, sorry, are we talking about distributing profits to kids via a trust, or I'm just not understanding that
Yeah,
question?
Sean. Okay. Do you want me to unmute you, Sean, and you'd like to ask the question directly? Here we go. I'm going to ask to unmute. Where are you? Oh, sorry. Sean, are you there?
Yeah, I'm here.
Alrighty, there you go.
Yeah. Sorry. Thank you for that. Yeah, just wondering if, say we made a decent development and we wanted to set up a trust account for each one of our kids, do they get taxed on that type of account, or?
Okay, so there's two different things when we're talking about the trust. So is the trust running the development, makes a profit and then distributes to the children, or are you then talking about separate trusts for the children?
A separate trust for each child, but like after we've already done the development and we've already taken care of everything else and we've taken our own chunk type thing. So it's out of our own funds type stuff.
Oh, okay. All right. So this is, yeah. So this is totally different. Yeah. So the trusts, obviously you'll pay tax on any earnings in that trust. So if there's 100,000 in there, I'm assuming it's invested in some form, whether that's with the bank or some other way. So any income that's being generated from those monies will be taxed. Yes.
Right, but if it's just sitting there accumulating, does it get taxed much, or?
Well, when you say accumulating,
say one of our children is 13.
Yes.
At the moment, and we put, say, $100,000 in a trust account for them, and it just accumulates a bit of interest.
Yeah.
So what's the deal on that?
You'll pay tax on the interest.
Yeah. Okay, cool.
Yeah. So you will pay tax on the interest, and minors can only earn up to $416 without being taxed for any distributions from a trust. And adults will be taxed at their marginal rate, whatever that might be.
But if they can't touch it though till after they're 18, does it just sit there, or do you still have to take care of that type of thing, bit by bit?
No, you're still there to account for it each year. You'll need to. Each trust needs to have its own TFN in a sense, and it needs to report every year its earnings and pay tax accordingly.
Right, cool.
But based on whoever you distribute those monies to. Remember, we're talking about on paper, because if you're accumulating them, that's fine. You can do that, but there needs to be a distribution of those earnings to a beneficiary who will then pay tax accordingly.
Yeah. So, what if they turn 18 and they say, "I just want to take the whole lot"? What do they pay tax on that as well, or?
No, they only pay tax on earnings. Once you gave them the right, or they had the right to take all of the funds, then they wouldn't be paying tax on that. No, because it's monies that's already been taxed. Because that's money out of your profits and your developments and the like, or whatever other business you might have had. So tax has already been paid on that original amount. It's only tax will need to be paid on earnings each year until it's not earning anymore if they've been taken out and they've gone and bought their house or whatever they've done with those funds.
Yeah, so we always wondered about that, because that's what we want to do after things have gone well for ourselves, to get those things up and running for ourselves, get that sorted, make some profits and set some aside for them in that fashion. So always wondered.
Yeah, well, that's it's a great idea, and obviously as parents, we always consider obviously our kids' future and helping them out, and if we can give them a kickstart, that's great. I mean, whether you do it in cash, Sean, or whether you do it in with some of your developments, whether you hold some of those things for the kids, they're probably a little bit more difficult to access and flip, which is probably a positive. And what's more, it's probably going to grow at a far better rate than money sitting in a bank earning at the moment 1.5% to 2%.
Yep, definitely agreed. Thank you.
No problem.
Thank you. And we've just got another question. One last question from Heath. Heath, I might get you to unmute yourself. Where are you? There we go. And he's asking, can you talk through the best way for a developer to structure a JV agreement with a landowner, example structure and tax implications? I guess for both the landowner and the developer. Heath, would you like to let me unmute you? There we are.
Hi, how you going? Yeah, just a question around really the tax implications. We're looking at doing a development with a landowner, and we're discussing it with a number at the moment, and just want to get our, I suppose, tax in order and JV structure in order for both us, but also them to help get the deal across the line. We want to be avoiding double tax and stamp duties where possible.
Yes, and it's a very good consideration. So what is common is, I suppose, what is referred to as a special purpose vehicle, or SPV, and you and others on the call tonight might be aware of, which is essentially a separate formal structure either a company or a trust that brings together separate parties, such as a developer being yourself and the landowner. So the important consideration is obviously the original landowner to try and either retain an element of his land, whether it's a PPR or just simply on capital account, so he can access those concessions. And depending on how long he's held that land, it may even be pre-CGT, I'm not sure, because some of those farming examples that Cheryl mentioned earlier, go back, those landowners have held that land for a number of years. So depending on their situation, what we want to do is have their ownership be within either their existing structure as whatever entity is currently owning that land, and that any realisation of the capital value of a development, depending on how far the development goes, it's important that they can either access their original PPR concessions or their capital gains concessions. From your point of view as a developer, depending on, again, the terms of your agreement, if you want to enter into a development agreement, which is another method of two separate parties coming together, you can charge a fee for the development for you to essentially get your share and value out of the whole development. Bearing in mind, because of recent changes to stamp duty legislation, we've got to be careful that your development isn't necessarily just a fixed percentage of the end sales value of the property development, that it's more a fixed type structure. But again, I would probably point you to a couple of good lawyers in this area who can draw up development agreements so you're not crossing over that ownership boundary where you'd be subject to stamp duty.
And that's the big one, stamp duty and change of ownership. So in that first example that you talk me through, effectively what you're saying is if the landowner has a property in their own name, we can enter into a side special purpose vehicle agreement where the landowner can still benefit from having the property in their name and no stamp duties, and they can benefit from PPR, but also both parties can benefit from tax in the new entity in terms of the additional value added through the development is taxed through the new entity or the new structure rather than...
Yep.
Okay.
Yeah, that's right. So I suppose we need to, there's probably a lot more to it, but, and understanding exactly what type of development, is done here. But the less the landowner is seen as being involved in the development, the more likely that any gain that he makes on the sale of his property will be considered on capital account if there's a change to the property, i.e. A subdivision, etc. So the less the landowner does, essentially the less tax he'll be subject to, because he'll be viewed as just getting a capital appreciation and realisation of the land that he has always held. And the developer, i.e. yourself, has come in and done the development, and your best structure from that point of view, again, without knowing all of your details, may be in a company type structure where that particular company does the development, generates its profit, pays its tax at the 26 or 25% company rate, depending on the completion, and you go off on your merry way with your share of profits.
Thank you for that. Appreciate it.
No problem.
Excellent. Thank you, Tony. And you can send me the bill through to Heath and Sean later. I'll take my little clip here. That was extremely generous of you, Tony, and appreciate the time for you to be just sharing. Something I said. It's so important for us to be looking at development from that business sense and all the implications behind it. So before you even delve into your first project, have a sit down with someone who really understands development. Your accountant, get your team in place, and that includes your lawyer and your accountant. Particularly ensure that they understand development inside out.
Yeah, absolutely. And like I say, I think people shouldn't be afraid or try and avoid the whole issue of tax. You should tackle it head on. With your advisors. Sit down in that financial feasibility phase and just run those numbers, understand what it means and what it means to your development, and how you might be able to save, and what is the best structure, because obviously structure plays a very important part. And then this might be my strategy, but what if I do change my mind? What if I decide that at the end of it, actually I might not sell them all, I might hold one or two, or vice versa. If I'm looking at holding them and then decide to sell, what does that mean? So asking those questions and being on top of it. So at the end of the day, you're the one who's going to decide what you ultimately want to do with your development. It's your advisors and your support team who are going to help you through that journey to make sure that they minimise any cost. And obviously there's things like asset protection as well. Let's not forget that. So it's a matter of making sure you're set up correctly, and it's all in the planning. Like they say in the property game, Cheryl, and I'm sure you've probably heard all this, the real profit is made in the buying, not the selling. And so that's the same from a cost and a tax and a structuring point of view. All the benefits at the beginning, not at the end. So you need to make sure that you've got all that right, and that planning and that strategy piece is pivotal to achieving the right outcome for you.
Fantastic. Thank you, Tony.
No
Anyone
problem.
wants to get in contact with you, again, need to be able to get your hand on this book if you are looking at seriously making a business out of development. Thank you, Sean. Thank you, everyone, for your participation and all your questions. And we will see you again very soon. Keep well, keep safe, and I'm sure we'll all get out of this this whole corona thing bigger and stronger, particularly if we're all in this together.
Absolutely. Thank you very much, Cheryl.
Excellent.
Thanks for having me.
Thanks, Tony. Take care. See you later. Bye-bye.
Bye-bye.